Bob, tell us a little bit about where we are at Monday, Halloween. Happy Halloween, by the way.
Yeah, it's happy Halloween
October
to you.
31st.
I was gonna dress, but I left my costume, back at the house.
Skylar and I did that one year. I might, and we were actually live that year. You remember that, Skylar?
I do. I think you were a baseball player and I was a Stingray.
Yes, you were a Stingray, and we were totally streaming live. We may have lost Skylar. And
sorry,
she had the Stingray, and she actually went to wave hi to everyone, and it was one of these. And I couldn't control myself. It was the funniest thing I've ever seen Skylar do, and wasted about 20 seconds on good laughter. So, but anyways, let's get into the mortgage.
It's Halloween, and we know what happens there. A little scare going on, but the market is also a little scary. This week we have the Fed meeting starting tomorrow, and we also have the jobs report that comes out later this week. So, tomorrow the Fed's going to be meeting, and we're going to hear from them on Wednesday at 2 p.m. We touched a little bit on this last week, but we're really looking at what their forward perspective on rates are going to be. We already have a pretty good indication and know that they're going to be increasing the Fed rate by 75 basis points to get it to that 4% mark, right? We're very comfortable with that position. The markets have already priced that in. It's just what that forward perspective is going to be, and that's what's going to set us up for either a market decrease or again a market increase. The bond markets right now are down 33 basis points, already anticipating kind of another commentary coming out of the meeting on Wednesday that just basically states and says we're going to be increasing it 50 to 75 basis points. So if we get any better forward indication, then we're going to see a rally this week. But the other thing that's important is, typically the 30-year fixed rate mortgages, they have a normal spread between the 10-year treasury, and it's about 175 to 200 basis points spread between the two. And right now we're sitting at 300. Mm-hmm. And the reason it's so high is we have in mortgages, we have servicing values that price into loans, and that's also part of like the delta and how mortgage companies and then owners of the mortgages will make money, right? Mm-hmm. Well, what we're going to watch and follow going into next year is does that spread come back down closer to where we normally have a range of about 175 to 200? And if it does, that's giving us a really good indication that the markets do 100% believe that inflation should be coming down, the 10-year treasury is going to be coming down, and mortgage rates are going to be coming down, because the lower the spread is between the 30-year fixed rate and the mortgage rates mean that there's just less value in the owners to service the loan, so they're not making as much money right on that spread, because the mortgages aren't going to stay on their books. Right. They priced it in and said, okay, we may get a 5-year or 7-year run on this, and now because interest rates were at 2.5%. Now, if we're figuring that all these mortgages that were booked may start coming off of those and they're going to be less valuable, then that should means less money for the servicers, and then actually a better position for buyers coming into this market.
Yeah, that's that's amazing. We're in I don't want to call them turbulent times, but we're in a transitional point in which so many people are just waiting to see where we land before they make their decision. Before they make their purchase, right?
Yeah. Mm-hmm. Yeah, and I think that's where just the education and the strategy comes in, right? I mean, we know that rents, last year rents, one of the largest increases ever at 18%. This will probably be the second largest increase we'll see in rents coming into 2022 when all the data is finalized. That's not slowing down, so they're putting their money somewhere, and it's going out, whether it's to rents or it's the mortgages. And to Skylar's point before, I would argue that, this time isn't a bad time to purchase, considering what they had to go through as a buyer's agent and as a buyer in 2020, 2021, because they were having to put up an extra $100K on a house that maybe only appraised at 500, and they had to come up with an extra 100K to make it work at 600, right?
Yeah.
And yeah, they got the lower rate, but they lost that 100K completely. That investment's gone, and they're going to have a little bit larger or longer time period in the house for that ROI. Today, it's about a strategy to get you in the home, and you're not having to pay the 100K over, right? You can get in now, even though the rate may be, depending on the market, depending on the type of loan we do. We're doing ARMs in the 5s, fixed in the 6s and 7s, depending on credit scores. Then we may just look at this over a 12 to 18 month period before we then look at refinancing you. So it's still a very healthy conversation that we're having, and we have a lot of them every day with buyers, because the market is still very active.